The modern global stock market runs on speed, vast liquidity, and extreme financial entanglement. Every transaction is connected to thousands of others. Yet some investors attempt to place a strict ethical filter over this chaos. Islamic capital markets are governed by strict foundational axioms. Investors are completely prohibited from participating in riba, the collection or payment of interest, and gharar, which includes guaranteed returns or excessive uncertainty in a contract. For centuries, these rules operated as a simple, zero-tolerance firewall. If an industry was illicit, you simply did not participate in it. But looking at a massive electronic display board like this one highlights the difficulty of applying a zero-tolerance philosophy to thousands of hyper-entangled public equities. Translating these concepts into modern capital markets requires moving from broad philosophical ideals towards the granular realities of financial engineering. The most common assumption made by new investors is that a Shariah-compliant stock works exactly like a dietary label, expecting complete purity. If you look at the certification on a retail storefront like this one, food safety regulations are binary. The product is either passing or failing. A cut of meat that is 99% pure is still rejected. Public corporations do not operate like cuts of meat. A multinational logistics company or a massive tech firm has thousands of overlapping revenue streams stretching across dozens of countries. Because almost every major corporation temporarily parks its cash reserves in conventional commercial bank accounts, achieving absolute insulation from interest is mathematically impossible. To navigate this reality, regulators rely on dedicated governing groups like the Shariah Advisory Council, or SAC. The SAC does not enforce absolute purity. Instead, they engineer a precise quantitative threshold architecture to isolate, measure, and tolerate negligible exposure. This animated funnel illustrates the first phase of the SAC screening algorithm, isolating specific revenue sources from a corporate income statement. Explicitly forbidden activities are capped by a strict 5% benchmark, never exceeding this fraction of total revenue. As seen on the prominently displayed rate board in this conventional bank, commercial interest is the primary target here. It seeps into almost all corporate accounts as a byproduct of holding cash. Another example is incidental alcohol sales. A massive international airline or a national grocery chain will generate the vast majority of its revenue from permissible logistics, while maintaining a tiny fraction of illicit sales. This naturally leads to the question of why any forbidden revenue is permitted to enter a Shariah-compliant portfolio at all. The 5% threshold is an engineering necessity. It exists because incidental exposure is systemic in modern corporate operations, and the threshold ensures investors can participate in the stock market without endorsing illicit activities themselves. The algorithm then expands to a wider 20% filtering layer designed for a different classification of revenue. This tier evaluates mixed activities. These are business operations that are permissible by default, but carry a high statistical risk of crossing over into non-compliance. A resort property like this one generates revenue from legitimate lodging and real estate, but that income is often mixed with uncertified food services, entertainment, or shared use facilities. This 20% limit also applies to commercial rental income collected from conventional banks operating on a property, and fees generated from conventional stockbroking. Expanding the threshold provides Islamic investors the mathematical flexibility required to allocate capital into broad economic sectors, like real estate and hospitality, without violating their core boundaries. The regulatory focus then shifts away from the income statement, moving to this balance sheet diagram to analyze how money is held and borrowed. The first liquidity constraint addresses parked capital. Cash placed in conventional bank accounts is divided by total assets. That ratio must remain below 33%. A parallel calculation applies to corporate leverage. Debt originating from conventional banking loans must also remain under the 33% cap against total assets. Even if a company clears every quantitative test, it must pass a final layer, the qualitative screen. If a restaurant mathematically passes the 5% limit on alcohol sales, but builds its public identity around a brand name that explicitly promotes heavy drinking, the council will veto the listing. Passing the math is merely the prerequisite. The corporation must ultimately protect a public brand alignment that does not actively degrade Islamic values. Because corporate balance sheets constantly fluctuate, compliance is not a lifetime guarantee. A sudden corporate acquisition, a newly issued bond, or a shift in cash holdings can push a previously compliant company past the 5, 20, or 33% limits in a single quarter. To monitor this, the SAC runs a sweeping biannual review process. Every 6 months, they publish an updated registry, officially delisting any companies that failed the latest tests. This creates an immediate operational crisis for an Islamic portfolio manager, who suddenly holds an active, illicit asset that they originally purchased in good faith. This transition triggers a strict regulatory protocol known as portfolio purification, separating the investor's protected principal from newly tainted gains. This chart tracks the divestment timeline. The investor sells the stock immediately upon the SAC delisting announcement. All historical capital gains up to that day are permissible. But if the investor delays and the post-announcement price rises, they profit from a non-compliant asset. The purification law requires that 100% of that post-announcement margin must be forfeited and diverted to charity. The framework also accounts for distressed assets. If the stock is operating at a loss on the day the announcement hits, the rules shift. In a loss scenario, the investor is permitted to hold the stock, but only until the price recovers to their original cost basis. The moment they break even, they must exit the position. Success in Shariah equity investment relies on navigating market entanglement through these mathematical guardrails and maintaining absolute discipline during divestment.